The world's most powerful tech companies have officially abandoned the public grid. While retail traders and investors are basically trading the same variations of the big AI tech companies and their ETFs, Silicon Valley has already pivoted to a different asset class entirely: nuclear energy. We are entering an era where the primary bottleneck for AI is no longer software or the number of Nvidia microchips and GPUs that you can get your hands on. It is the physical availability of energy, and specifically uranium. A high-stakes game of chicken is taking place across North America, and your portfolio is likely unprotected from it. A single massive AI data center can consume up to 10 times the continuous electricity of a conventional server farm. To ensure these AI models can keep answering your questions and drawing images with every prompt that you submit, these tech companies are aggressively moving up the physical supply chain. In Canada, this has already started, with the federal government announcing that they're going to deploy up to 10 new large nuclear reactors, effectively doubling the capacity of nuclear energy in the country. Mainstream financial media likes to show you these flashy stories of high-tech growth and their exotic founders like Sam Altman. But they're not actually going to talk about the numbers and the history. So let's break down the demand and supply for nuclear energy over the last 20 years and see how these trillion-dollar companies are preparing to completely overwhelm an inelastic physical supply. Because the scale of this AI industrialization is unprecedented. As we push through 2026, institutional money is already all in on AI, so this energy demand must be met no matter what. AI companies are writing massive 9-figure checks to directly to nuclear developers. The entities caught up in this shift in the market isn't just them, but also your local utility companies and industrial firms that need this energy. People are realizing that the physical fuel required to power the digital age is basically being locked away by big tech. So let's map it out. Let's look closely at this first chart. North American data centers and industrial reshoring are forcing an unprecedented pivot upwards in the nuclear baseload demand. Between 2025 and 2035, the continent's nuclear energy load requirement is projected to increase by over 60%. But look what happens when you overlay the demand for nuclear against the supply for uranium that powers it. That's right, it's plateauing. For 20 years, the primary global uranium mining has struggled to consistently surpass 60,000 tons a year of uranium. In fact, current mine production only accounts for about 90% of normal global demand. The remaining amount is actually quietly filled by drawing down existing nuclear stockpiles. The global supply chain has spent 10 years underinvesting in primary enrichment and extraction capacity. It is structurally impossible to mine an output and scale instantly to match a sudden increase in demand from this tech-driven AI surge. So what is going to happen next? This final column represents the logjam. Refining this raw uranium yellowcake into actual enriched fuel rods requires specialized, highly concentrated enrichment infrastructure. And North America has just one enrichment facility, the Urenco plant in New Mexico. Historically, the US has imported about 25% of its enriched uranium from Russia. However, the US government has banned the imports since 2024. The Urenco plant has a maximum capacity of 4.3 million units. So, to meet this new demand for nuclear energy, Urenco has announced an expansion of its current facility and a new facility to be completed by 2030, bringing total capacity up to 7 million units a year. Now let's look at the institutional moves, because they already know this. This is what investors are missing on the retail side. In a normal commodity cycle, utilities will buy fuel on long-term schedules, and the price increase acts as a mechanism to increase supply, as the extraction companies will then extract more if the price is higher. But big tech doesn't operate this way. Companies like Google, Amazon, Meta are sitting on an unprecedented amount of cash, and they are facing extreme pressure to scale out their AI compute capacity before the competition does next to them. They don't care if the fuel costs double or triple. They are entirely price inelastic. It only represents a fraction of their expense budget. The ultimate surprise in all of this is that big tech is completely bypassing the public electrical market. They are directly backing the next generation of small modular reactors called SMRs. Google has already locked up a major multi-reactor commitment from Kairos Power. Meta is backing advanced liquid metal designs via Oklo and Terra Power. So let's look at their capital, because this money isn't going to support your local municipality power plant or your local utility grid. This money is from private companies that are trying to corner the supply. AI giants are structuring these contracts as behind the meter, meaning nuclear reactors will feed electricity directly from their plant to their AI data center. This is completely isolated from your grid and won't affect your rates at first. But they're weaponizing their balance sheet to hoard the most reliable fuel source on Earth, nuclear, and effectively crowding out regional utilities who can't afford to meet their aggressive pricing, who are going to take over. So, to execute a strategy based on this bottleneck, institutions are not running after the speculative mining companies that are extracting the uranium itself. No, they are focusing their playbook on two specific areas. First, look directly at the dominant enrichment monopolies in North America and their equipment suppliers, because these firms possess massive pricing power and are uniquely positioned to capture high-margin, premium contracts from these AI tech giants. These tech giants are going to outbid your local municipality for this supply of equipment. Second, monitor the development timelines of the regional public utility grids. They're all planning upgrades up to 2030 and 2035 in North America. But the moment local regulators start to delay or cancel these upgrades means that the squeeze from energy and the squeeze on supplied equipment and raw materials is officially on. And if they're being affected, then that means that tech giants could also be affected if they have not secured their own supply of these materials. That's the squeeze that we're looking for. AI is shifting the very way companies power their operations, turning clean energy from a nice-to-have ESG, save the environment, to a must-have to power the future of their growth and for survival. This is exactly why the world's largest governments are no longer treating utility lines like they're boring public networks, but are instead looking at them as arteries of economic security. Subscribe for our next video and ring the bell where we deep dive into the national security of AI.